Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Uber Technologies stock. This one came in by request down in the comments section of one of my other videos. If you have a request you'd like me to take a look at, just put it down in the comments. I'll get the ticker up on the chalkboard behind me, and eventually I'll make a video. I feel a little bad because this one's been on the list for quite a while. But I did just finish one column that I erased there, and I think by the end of this weekend, I'm going to get this other column completed. So I'll be catching up with everyone's requests. And Uber was a little tricky one, so I kind of delayed it a little bit until I could, form my thoughts a little bit on how I wanted to go about doing it. So, as always, this is not individual investing advice. This is just how I analyze stocks. All right, so Uber. I always start by looking at the historical earnings, and we can see that it looked like they were briefly profitable before they went public. And then after that, the stock price kind of fell going into COVID and then coming out, but they weren't really making any money during this time. And just on the real earnings here, like on the adjusted earnings, it didn't even really look like they were moving necessarily in the right direction. But now we have positive earnings. Let's see what the basic earnings look like. I think they're similar because I peeked at them earlier. Yeah, pretty similar looking. So now they're profitable, but we don't have a lot of historical data to go on. So this is one that you have to kind of keep in mind. We don't really know what will happen in a recession. We really don't have a lot of data on what the longer term trajectory is going to be. I would say one of the things that I don't like, or that I don't like the most, I think that's the way to say it, that I don't like the most about them is that they're already just really big, right? This is a $167 billion company already, and they only went public a few years ago. So to me, I don't really like it when these giant companies stay private forever and then they go public and then there's just not that much growth left. I mean, Uber's everywhere that they're probably ever going to be already. So it makes it hard for, it's not super enticing as an investor over the medium and long term, which is what I'm looking for. If I'm buying a newer business that isn't as established, that doesn't have a long track record, I want that risk that I'm taking to be made up for in longer term growth potential. So like think 5x or something like that over 10 years is just rough, or more. But I mean, realistically, if you buy a smaller business, you hold it that has growth potential, but it's riskier. In 10 years, if you can get a 5x out of it, you can miss on a few of those you can miss and have some of those be bad investments and still do really well as an investor. But if you're buying a business that's already $160 billion, in order to 5x, it's going to get to like, 800 billion or something. I mean, now it's not to say it's impossible to do. I mean, there are companies that like Alphabet and Meta that have done it. I'm trying to think of any more off the top of my head. Well, there's some that are briefly like crazy expensive, but I mean, they have a long-term trajectory that's going to go into like the $1 trillion market cap area. I think Uber could, but you have a better chance buying, let's see. Yeah, when it's like 2/3 lower, right? Like back here, than you do kind of when it's already pretty expensive. That said, Uber's is the dominant player in their field, in their industry. So there is some good things that come along with that, but there are also self-driving cars, there are robot delivery companies, and so it's not like they have no competition or they're just going to completely necessarily dominate that area for a long time. We don't really know that. So that's the broader picture of kind of how I think about Uber. Like, I would want a smaller business, preferably, if I'm going to project out growth for a long time, which is probably what we're going to do here. We're going to have to do, and we're just going to have to kind of speculate a little bit. But I'm going to try to put some numbers on it just as a baseline for people to think about. I do have a buy price on it that I would consider buying if it got down there. But So, and again, even with these earnings, analysts are expecting earnings to fall off this year and then start to recover. I don't know what that's all about. Usually with these type of businesses, I want them to kind of smoothly be growing earnings well most of the time, not to have these kind of unpredictable swings. And maybe there's a good reason for like all this. I don't know. But the way I'm going to do this is what I want to try to project is how long it would take an investor to earn their money back just from the company's earnings. So if you bought $100 worth of Uber, how long would it take them to earn $100 over time from their earnings in order to pay back? So usually 10 years is what I kind of aim for as a rough time period right now. There's a few variations on that, but as a ballpark, that's what we aim for. Now, the tricky part with these guys is if we start with this year's earnings, well, earnings are expected to sharply decline next year. So by 50%. So that totally would throw off like a calculation. But what I'm going to do is I'm going to look forward 2 years. I'm going to use this number here, which is kind of in between these, as the starting point. And then however many years I calculate from there that it will take to pay back, I'll add 2 years onto it at the end. And that's a way to try to come up with like a medium. Because if you look at it from this point and just extrapolate growth from that point, the valuation looks pretty good. I mean, it's only trading in 18 PE. They just grew earnings 400% or something. So you can see why somebody might be tempted to do that. But when we look at what analysts are expecting, they're expecting earnings to drop 50% before they start growing again. And so one way to do that, without spending a bunch of time on it, is just to give analysts their kind of credit, look forward a couple years, and then we get that dip and we get kind of a comeback. And we can go from there and kind of see how it works out. So that's what I'm going to do. Let's see here. Let me find the right spreadsheet. I think this is it. Okay. So what I'm going to do here, I'm not going to account for any debt or anything. I'm just going to use the straight up stock price. And I'm going to assume after these 2 years, Uber can grow earnings 10% a year on average for however long it takes to earn a person's money back. You can use a more aggressive earnings growth rate. I think 20%, which is always my maximum that I ever use, is just too fat. I don't think there's any way they can grow 20% for 10 years. It just seems totally unrealistic to me, unless there's like hyperinflation or something. So 15, I think, is maybe somebody could go for that, especially since we're kind of starting from a lower earnings base in a couple of years. Maybe they don't disappoint. Maybe they hold earnings and those perform better at the beginning. So I think if a person wanted to use 15% assumption, that's still, I would say, top of the optimistic. I'm going to use 10%. I think that's a fair balance between, it's still double-digit growth. That's still really good growth, but we know that there's going to be competition over the next decade in their industry, and that lots of people are aiming for self-driving cars that could directly compete with their business. So I think that 10% is a kind of a good balance, and that's what I'm going to go with. So looking forward 2 years, they're expected to earn $3.39 a share, and that's going to form an earnings yield, which is the inverse of the PE ratio. So instead of price over earnings, it's earnings over price, and that forms the earnings yield. So it's really just a different expression of the PE ratio looking forward 2 years using the current price. And that comes out to 4.27%. So if you owned $100 in the business or you bought the whole business for $100 and you owned it all, you would earn $4.27 on that $100 the first year if there wasn't any earnings growth. Now we're gonna expect 10% growth. So I set the spreadsheet up to calculate this out, and I'll just kind of show you the beginning of how it works here. If I can get over there. Okay, here we go. So here we have the earnings yield converted to dollars. This is based on a $100 investment. First year you would earn $4.70. You keep that. The next year you earn $5.16. You keep that, and you want to see how long it takes for that to build up to $100. All right. And once I get us back here we go. So when we run out that calculation, we get 12 years if you assume that earnings grow 10%. But remember, we jumped forward 2 years in order to start our calculation. So that 12 years would really be 14 years. Right now, the S&P 500 is trading at about 15-year time until payback on average. So maybe slightly undervalued compared to the S&P 500 using these assumptions. But I think these assumptions are kind of in line with what the market is probably thinking here too. So an investor will just have to kind of think what they think is reasonable. If you wanted to, let's see, I left a note here for myself. Okay, so yeah, if you wanted to know when would be a buy at that 10% earnings growth rate, it would be a buy at about $42 a share. So a little less than half of a decline, half a 50% decline, like a little less than that, in between 45 and 50% decline from here, which sounds like a lot, and it is, but a lot of stocks in the market are kind of trading like that. And if we go back, what did I say, $42? We were at $42 in October 2023, right? So let's say, now I know analysts are expecting earnings to fall, but maybe they fall a little worse, or the market doesn't expect it, and we get a bad forecast. The stock could easily trade back down there. Now that might affect this earnings expectation in a couple of years, right? So maybe this goes down too, in which case that buy price would get lower as well. But maybe it doesn't, right? I'm just pointing out that it sounds like it's a really low buy price. I really don't think that it is. And I think it could easily get down there, no problem, on bad news. But a person will have to kind of parse through that news and say, okay, is this news going to make 2026's earnings worse than I already expected they would be, right? And keep an eye on that number, that $3.39 for 2026. And then if that gets lower, then the buy price might even move down too. But we've seen with plenty of stocks where these big sell-offs can happen. So even if we just go back a couple years, you can see how much it fell, over 65%. So again, I think that's reasonable. That's a good kind of pin to put, on the board, and just to kind of give a rough range to aim for. And if you found this useful, hit the like and subscribe button. I have weekly picks over on Patreon at $25 a month, and those have been doing really well. It's been really popular. Check out that link in the description. I also have free tier on Patreon, so you can watch all these videos over there. I post all the same ones, and every now and then I'll do a little bonus over there too. So, and you can chat with me, message me, leave a comment, and I'll comment back. All right, see everybody later. Bye.